So you're thinking about buying your first home in India. That's huge. But choosing a home loan, yeah, it can feel pretty overwhelming. Don't worry. In the next few minutes, we're going to break it all down, give you the clarity you need, and help you make a choice you feel really good about.
I mean, let's be real. Buying your first home is such an incredible milestone. It's more than just a purchase. It's a dream that so many of us have worked so hard for.
But then, bam, you hit this wall. You start looking at the money side of things, and suddenly you're facing this massive, super confusing question. This is where that excitement can kind of turn into anxiety, right? But hey, that's exactly why we're here. We are going to cut through all that noise, get rid of the jargon, and just make this whole thing simple. So why is this one decision so important? Well, it's probably the biggest financial step you'll ever take. Let's start with the basics, because really understanding the why behind it all is going to set you up for success.
First things first, what even is a mortgage? Well, at its core, it's just a loan from a bank or lender that lets you buy your property. And that property, it basically acts as a guarantee for the bank until you've paid the loan back in full. Simple as that.
But here's the part that really puts it all into perspective. We're not talking about a car loan. We're talking about a commitment that lasts for 20 to 30 years. That incredible length of time is exactly why every little detail matters so much.
And this right here, this is why you've got to pay attention. You might see a tiny difference in interest rates, like a fraction of a percent, and think it's no big deal. But stretched out over 2 or 3 decades, that tiny difference can literally mean paying lots and lots more. It's huge.
All right, so that brings us to the first big fork in the road. When you're picking a home loan, you're basically choosing between 2 different ways of thinking about your money. Let's dive into what those are.
And here they are, fixed rate versus floating rate. One gives you predictability, that peace of mind. The other gives you a chance to save money if the market moves in your favor. This is pretty much the central choice you're going to have to make.
Let's look closer at the fixed rate. This is for all you stability seekers out there. Your interest rate is locked in, which means your monthly payment, your EMI, is exactly the same month after month, year after year. It makes budgeting a breeze. It's like setting the cruise control on a long highway drive. You just set it and forget it.
Now, on the other side of the coin, you've got the floating rate. This is for the flexible navigator. Your interest rate moves with the market, which is great if rates go down because your payment goes down too. But it also means it can go up. The analogy here is perfect. It's like sailing. You might catch a good wind and get ahead, but you absolutely have to be ready for the occasional storm.
Now, what if you're thinking, I don't really want to choose just one side? Well, you're in luck. There's a middle ground called a combination mortgage. It's a hybrid that gives you a little of both worlds. It often starts out fixed for a few years and then switches to a floating rate.
Okay, so beyond that main fixed versus floating debate, there are also some other specialized loans out there. These are designed for really specific situations, so let's see what they're all about.
For a lot of people, government-supported loans can be an absolute game changer. Through certain housing schemes, you might actually get an interest subsidy from the government that directly cuts down the cost of your loan, making your dream home that much more affordable. It's for sure worth looking into to see if you qualify.
And what if you're not buying a finished home but building one from the ground up? Well, that's where a home construction loan comes in. The big difference here is that the bank doesn't just give you all the money at once. Instead, they release it in stages as you complete different parts of the construction. It's a really smart way to finance a custom-built home.
Okay, just a couple more options you should have on your radar. You might not need them right now as a first-timer, but trust me, it's really good to know they exist for later on down the road.
You might hear people talk about a loan against property, but listen, for a first-time home buyer, this is usually not the move. The interest rates are generally higher, there's more risk involved. So for now, you can probably just park this idea to the side.
Now, a balance transfer, this is a really powerful tool to keep in your back pocket. What it means is that your first choice of a bank isn't a life sentence. If, say, 5 years from now, another lender is offering a way better interest rate, you can actually switch your loan over to them. This gives you incredible flexibility on that long 20 or 30-year journey.
So we've covered a lot of ground, right? Fixed, floating, construction loans, transfers. Let's pull all these threads together now and build a super simple framework to help you figure out what's best for you.
This table really lays it all out pretty clearly. You can see it right there. If you crave stability and hate surprises, the low-risk fixed rate is your friend. If you've got a flexible income and you're okay with some ups and downs, the floating rate could be a great option. And if you want that best of both worlds approach, there's the combination loan right in the middle.
And really, it all boils down to this.
There is no single best mortgage out there for everyone. The right choice is totally personal. It all comes down to being honest about your job security, how stable your income is, and, just what helps you sleep peacefully at night.
So, we've laid out the map, we've shown you the different routes you can take, the power is completely in your hands now. So, take a moment, think about your own journey. Which path are you going to take?